Morgan Stanley is a company I like a lot right now for a number of reasons. One, it's a non-tech stock that has performed well, 150% in 5 years. Maybe you're looking at Nvidia, that doesn't sound super impressive. Do understand the S&P 500 over the last 5 years, which is the market, is only up about 90%. Morgan Stanley is up 157% while paying most of that time a dividend that was substantially higher than the S&P 500. But even after it's run up so much, it's still double the S&P 500. So you've dramatically outperformed. And if we go back to 2015, you were at about 38-ish, early 2015, 35-ish. So you've outperformed the S&P 500 at that metric as well, considering the S&P 500 is only up about 200% over the last decade or so. Also, like I said, it's a company that's non-tech that is performing very well, outperforming the market. There's not a whole lot of companies in today's markets that are doing that, certainly when you look at financial institutions. So today we're going to be diving into Morgan Stanley. Okay, it's run up this much. Is it still a buy? Is it just a fluke? Is it just running up off of hype? What's the earnings per share? We're going to dive into all that stuff concerning this stock in this video. Before investing in a company, it's important to actually understand what that company does. And luckily for me today, Morgan Stanley, it's really not that complicated. I don't have to sit here and try to explain some crazy tech innovation that this specific company does that I barely understand. Morgan Stanley, they just help people invest. That's it simply. Now, if we're going to break that down a little bit, I think this blob here in Schwab, I don't think the description of companies is always too well, although you can pause it and read this if you want to on the right side of the screen. This is way simpler in my opinion. The company profits are derived from institutional securities, wealth management, and investment management. So where all their money comes from. So they just break it down to a couple different categories. So you can read these three individually if you want to. That's where they get all their money. That's where all their profit comes in from. So just simply, they help people invest. And in my opinion, that's why Morgan Stanley is different from some of the other quote unquote financial institutions. Obviously, they're not anywhere near like a normal traditional bank like Bank of America, CD Bank, Wells Fargo, something like that. And those companies, although they've done okay, certainly for what you're expecting them to do, you're expecting them to underperform, the traditional market, certainly with tech, because tech just innovates so much, and with regulations put on banks like that, obviously. So after 2007, there's much more strict, regulations put on them. And before '07, you've seen faster growth from banks. But something like Morgan Stanley isn't a traditional bank, even though I kind of lump them in financial institutions. Maybe that's not even very good for me to do, but I like to do that because it simplifies and that works in my brain. But Morgan Stanley helps with investment. And because they do that, they break the mold from other, banks like that. And they're able to grow at the rates that we are seeing, right? 157% over 5 years, along with a really, really solid dividend. So I think they can probably continue to go well, but we're going to dive into some of the number sides of things. Taking a look at the PE, we can see here it's at 17.5, and then forward PE is just under 16. Now, this appears dramatically cheap compared to the rest of the market right now. And, just look at it. The S&P 500 right now is at 30, forward PE around 23-ish. And then if you look at the Mag 7, only a handful are in the 20s. The rest are 30 plus, and some of them are much higher than that. And then if you take a look at even traditional dividend-value stocks like a Pepsi is in the high 20s. And that's not just that one. There's plenty of others you can find in that. Walmart's above 40, right? You see traditional, quote unquote, value stocks that are much higher, PEs in the 20s, things like that. Now, so this does have a PE discount. I'm not refuting that. However, you do have to factor in that generally financial institutions, companies that are in the similar area to Morgan Stanley, trade between that 10 and 20 PE range. Now, if they maintain earnings per share growth similar to what they've done since over the last decade plus, we're going to look at that a little bit more in depth or later in this video. But it really is, I don't know. If you could make the argument PE should be higher, but if you're looking at all the companies that do similar stuff, they're right in that range. 10 to 20 PEs, pretty normal, and you're right at about 17.5-ish. So looking at non-GAAP versus GAAP real quick, there's no change there, so we can understand PE is probably fairly accurate, and we can just move on from there. Now, when you look at earnings per share and revenue, it does seem a bit chaotic, and I'm not really refuting that. But so it's more important to look at long-term trends for these companies. It's really hard to get a gauge short-term, which is a bit of a barrier to entry to investing, in my opinion, but it's still important to look at. So you had a 15.8% decrease from 2022 to 2023 in terms of earnings per share, then a dramatic increase, and actually next year we're expecting kind of in that normal range, somewhere it's 9.5%, but S&P 500 generally goes up 10 to 11%. So 9.5% is kind of in that range. And certainly if you're not expecting quite as much growth as the S&P 500, which we're going to talk about projections also later, but then taking a look at revenue, also a bit chaotic, right? 45.9% increase, 11.5% increase, and then a 38% decrease. So a little bit chaotic there, but I think it's important to look at long-term trends. So let's take a look at that. First off, just looking at the balance sheet, it really is kind of incredible when you see just how many assets they manage and debt they have, but it's really not too important for this because it really matters more what you make off of it. So let's take a little bit of a look. Revenue has increased pretty dramatically since 2020 to 2024. You see from 52 to 107, that's a pretty steady increase. And you see a little bit less steady increase when it comes to profit, which of course is the main point of things. Now, generally, if you can increase the trend of revenue, that's probably more stable in this line of business, but earnings per share and profit is technically what matters the most because it doesn't really matter how much revenue you do as long as if you don't make a profit on it. But generally, revenue is going to correlate with profit with these sort of companies. And we can see if we just go off where we're at, 14.4 billion in 2020, so now we're at 17.5 billion. But we did have a kind of spike outlier year in 2021. Investments did very well in 2021. Most of you remember that. They grew very fast. There was a drop down during COVID, and then everything shot right back up, highs in 2021, tech and all that, and then there was a downturn in 2022, 2023. So we can kind of see that. We can see that play out in the earnings per share line. But what we're seeing here is constant revenue growth throughout that, which is important because, hey, if we're growing that's important. Now, usually I like to make a nice stop in between this, but let's just go straight into the PE because it plays a role. It's really hard even with just 5-year outlook to really gauge how much they're growing. So if we're looking back here, I like a good 10-year time frame. So we're going from 10 years, 2014, 2015-ish. We were somewhere in that, so late 2014 to early 2016, you're kind of in that 1.6 to 2.27 earnings per share. And then if we're looking to where we are now, we are at 7.94. So a dramatic increase. We saw a really fast increase up into 2021. But you could see by the stock price, although it did shoot up, there was tempered expectations. People kind of understood, okay, there's probably going to be a little bit of a downturn because that was so quick, that was so fast. Is it stable? Is it going to last? And then eventually we are starting to go back up. The earnings per share has climbed back up into that 7 range, high 7 range, and that's where we are now. Stock price up dramatically as well. So believe it or not, going from 1.5 to even 2.5, and then up to about 8 earnings per share in a 10-year time frame is very, 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 very good. Certainly when you're looking at a non-tech stock. Non-tech stocks traditionally don't do this. Of course, you can find examples. I'm not saying none don't. There's plenty of examples that do. However, when you can find a company that is as large as this in this specific area, and I know there's certainly specific investing companies, financial institutions that do this sort of thing that have done well. You can find them. But it's difficult to find them quite this large, and there's not a lot of examples. When you're looking at something that has $222 billion in market cap and does this specific type of thing in this specific area, there's not a whole lot like this. And generally, it's becoming more rare, in my opinion, to find companies outside of tech that can get growth rates like this for a number of reasons. One, because generally people don't want to invest in non-tech stocks to find growth. So oftentimes those companies just aim for a more dividend mindset. But also, it's just a different world. It just is a different world than it was. And growth rates like this do not happen with companies like this. Now, that doesn't mean they can't continue to do it, but it really is remarkable what they've done. I don't think that should be discounted. Now, looking just at PE, you're kind of somewhere in that 10 to 15 range. I mean, obviously we were lower in 2018, under 10, even as low as about 7. And the market PE generally was even a bit lower then. But I really do think this just came down to the market was underselling them. And that's why I was saying earlier, if we see growth like this continue, you will get PE in the 20s. You see it for companies, even something like a TSM, they traded somewhere in that 15 PE range. And then they've proven themselves now to be able to grow and grow and grow, and people are going to pay that premium for them. even though Morgan Stanley is in a field where traditionally you do not see PE levels above even something like 20. 20 is like the cap. If they can continue to grow revenue and earnings per share anywhere near the rate they have been, you're going to see the PE continue to climb up. You're just going to. Because they're going to, two things are happening. One, they've proven themselves over a longer time period to be able to do this. So people trust it more, and that ties into people willing to pay higher premiums for it. So yes, two things can be true. Once we are high historical PE, traditionally we have not really any time in the last decade outside of this point. That was just a slight hiccup. I'm guessing it was even something non-GAAP or GAAP distorting the actual PE. So outside of that, you really haven't had any PE this high, really since 2014, or really, and that doesn't even really count because they were coming out of unprofitability status in early 2012. So this is technically about as high as it gets historically. But you would expect a company that has grown and done this well to have PE in this area. And like I said, if they continue to do this trend, mark my words, they're at what? They were at 2, let's just say 3. 2015, late 2015, they're at 3. That was a bit of a peak, but let's just go off that. They're at 3, now they're at 8. So what's that? 2.5-ish growth? 2.5xing-ish, roughly. If they 2x over the next, if they 2.5x over the next decade, they will definitely, and like I said, that's a non-optimistic look. That's a fairly conservative look for what they've actually done over the last decade. But if they 2.5x over the next decade, you are going to see PE levels in the 20s. So you'll get share growth there. I would nearly guarantee it, unless there was something weird going on in the market during that time period. Every company has unique risks and advantages, and it's important to lay them out before you invest in any company so you understand the unique risks or advantages that you're counting on or are hoping to avoid when it comes to this specific company. With Morgan Stanley, there are a couple. Let's look at the risks-negatives side of things. One is their PE historically is higher, we've talked about this, than it traditionally has been. In 2018, you're around 7 PE. Now you're at 17 PE. So there's a bit of a dramatic increase there. And just also, you're a bit of an outlier. Morgan Stanley is a bit of an outlier. There's not a whole lot of companies to go off of. It's one of the larger ones, not a lot of ones their size, but statistically, it is an outlier company. So that doesn't mean the outlier can't continue. I like Morgan Stanley, spoiler alert. I do. I'm not necessarily counting on them to continue the growth multiples they have been, but if anyone can, it's probably them in this space. So that's some of the negative sides of things, of course. Regulations, things like that. Generally, you can, I don't know, they're fairly set, but there is a track record of large financial institutions maybe not making the best decisions. I'm not accusing Morgan Stanley of anything, and honestly, I'm not even sure they would be able to because they do unique stuff. But who knows? There's been companies that have done stuff like that. So let's just leave that there. But of course, if there's any unique risks I didn't cover, feel free to ask in the comment section. I would like to address them. Of course, I can't cover all of them in this video. Advantages. They've done well. I think when you look at the growth mixed with the dividend, this is a very stable stock because even if you get growth, people get out on Morgan Stanley in the sense that they don't really want to put more money in them. And once it runs sideways or goes down, you could probably DCA into this company. When I was buying in a while ago, it was well over 4% dividend rate. So it even here at these growth rates, it's grown. It gives a nice 2.5% dividend, nearly double the S&P 500, actually almost exactly double. So if this ran sideways and they continue to grow their business, people were out on it, down on it, you'd still probably be getting a 3 to 4 to 5% in an optimistic sense dividend ratio. That's not something to scoff at. That's capital. Whether if you're not reinvesting, you could still be fully invested in Morgan Stanley, get long-term capital gains, and still be able to dispose and use that capital elsewhere. That's not insignificant, in my opinion. So, but even if they were to go flat financially, well, if you saw them like completely stagnate and they weren't growing the business, you'd probably see a regression in share price. You get a higher dividend yield then, you get DCA into that, whatever it may be. When it comes to specific stock price projections, most of you watching this video either really like my content, Appreciate all of you guys, or you're really interested in Morgan Stanley. So I feel like I owe most of you here some form of stock price projection, although I've mentioned it before many times, I do not like doing it. I don't like doing it because there's so many different ways a stock can go that isn't necessarily dependent on how the company itself is doing. However, like I said, I think it's important to do. So when it comes down to it, I think Morgan Stanley is a good company. Full disclosure, I own this stock, I've owned it, and I've done pretty well on it. I'm happy with the performance, certainly because I'm not necessarily expecting it to do well. I like diversification. Some of you watching, probably not many of you watching because you made it this far in a Morgan Stanley video, but a lot of people in the market today are very, very, very tech centric. And I like tech. I own quite a lot of tech. I've done well on tech, but tech is going to get hit harder during a recession, during a downturn, whatever it may be. And it's important to diversify. So I do want to own some quote unquote value stocks, some non-tech stocks, some large stocks that have done well. And I want to own some that, like I said, have done well. And Morgan Stanley, I feel like, is a good bet to continue to do well. Do I think it's going to outperform the market? I don't know how I should answer that question. If you, it's the hardest one. I think it probably will. I think if you made me say, gun to my head, do I think it's going to overperform or underperform the market? I think it's probably going to underperform. However, I think it's pretty close to 50-50. Personally, they've outperformed in a 10-year time frame, they've outperformed in a 5-year time frame. That dividend is nice, very nice. But traditionally, like I said, one thing you probably noticed at the very beginning of this video, if you zoom out on it, look at this: 107 in 2000, 83 in 2007. And yes, you get a nice dividend during that time period. If we put it like we do sometimes on the total returns chart, it would look better than this. However, it's tough. It's tough to say anything that deals with large financial institution is going to outperform S&P 500 tech long term. It's just difficult in today's market to do that. However, like I said, the main reason I own this is it has done well. It seems like an outlier in the space. They've, like I said, they have performed well. They've performed well. They've performed well. I've said 100 times. They have performed well. Of course, there's no guarantee they will, but it's hard to find a company that hasn't performed well and say, oh yeah, it's going to outperform the ones that haven't. It's difficult to do that. And diversification is important. I like the dividend. It may go up, it may go down. If it goes down, that likely means they aren't cutting the dividend. It likely means the PE is higher and this is growing well. so that's not necessarily a bad thing either. But even then, you get almost a 3% dividend yield on top of that all. So I think Morgan Stanley is going to perform about right in line with the market. And considering it's non-tech and the S&P 500 is dominated by tech, and they can get a growth rate relatively near that. Even if you underperform, you do 90% of the market in the long term, and you have tech, and that tech does well, you're probably going to be pretty happy. So that's what I think, guys. I appreciate all of you for watching this video, making it this far. My voice is kind of worn out at this point, so hey, if you are a common watcher on this channel, I appreciate if you liked and subscribed. If you don't have an account, it's just not your thing. Totally fine. Appreciate making it this far, but look into making a Google account and hitting that subscribe button. It really does help, certainly at this level of growth of my channel. Any little momentum helps me. But anyways, I appreciate all of you for watching, and I'll catch you next time.